you have more gold and silver acquisitions by the world central banks and the sovereign wealth funds and the family offices and the commercial banks, and it's all coming from the top down and leading down the exchanges, and it hasn't found its way yet into the retail space. And I find it to be perplexing. I'm surprised it hasn't. I can only say so many times that you're not going to find a better opportunity to buy if that's what you want to do to protect yourself from what is coming. And if you don't see what's coming, you're really not paying very close attention.
In a noteworthy development in the financial world, central banks are making a surprising shift in their investment strategies, moving away from US Treasuries and increasingly favoring gold. According to Andy Schectman, the CEO and president of Miles Franklin, do not let go of your gold and silver. One striking observation is the changing volatility dynamics between these two assets. Schectman points out that, for the first time in decades, U.S. Treasuries are exhibiting more downside volatility than gold, making the precious metal an attractive choice for risk-averse investors. The World Gold Council's analyst, Krishan Gopaul, reinforces this trend, characterizing it as a continuation. Central banks increasingly turn to gold due to its reputation for maintaining value during turbulent economic times. Unlike traditional currencies and bonds, gold isn't reliant on any issuing authority or government, making it an attractive option for diversifying central bank reserves away from assets like U.S. Treasuries and the dollar. Adding weight to this trend, analysts at Bank of America highlight that a down year for Treasuries in the current year would mark the first three-year downturn since the founding of the American Republic. Further underscoring this transformation is the decline in Japan and China's holdings of U.S. Treasuries to record lows. Japan's holdings, totaling $1.1 trillion, now represent just 4.4% of the total, while China's $835 billion is equivalent to 3.4%. Although these figures are dwarfed by the Federal Reserve's massive 20% share of $5 trillion, the trend is unmistakable. The two largest foreign buyers of U.S. Treasuries are reducing their holdings at a time when the United States is issuing more debt than ever before. Andy Schectman suggests that central banks are pivoting from U.S. Treasuries to gold due to its perceived safety, echoing its status as a secure investment akin to Treasuries. This shift is not just a minor market adjustment, but a significant transformation in the financial landscape. Before diving into Andy Schectman's insightful interview, subscribe to our channel and give this video a big thumbs up.
I think one of the things to talk about with BRICS is that so far this year, they've offloaded about $123 billion in U.S. Treasuries, and China being the highest with about $118 billion, Brazil, $2.7 billion, India, $2.3 billion, the United Arab Emirates, $300 million. In total, the BRICS countries have removed $122.7 billion worth of U.S. Treasury bonds. And I'm going to get to something very interesting about that in a moment. Actually, let's talk about it right now. It's interesting. What is the one thing that I've talked about maybe that started this entire journey with you, as I used to call it, a linear progression of events, is the Tier 1 revision of gold. And in April of 2019, gold was revised as Tier 1. Now, prior to that, since the end of World War II, it was U.S. dollars and U.S. Treasuries that were Tier 1. So keep that in mind. As we mentioned, you have all the BRICS countries shedding treasuries in favor of gold. And this is really crucial, what I'm about to say, and that is that for the first time in 45 years, the U.S. treasuries now have a higher downside volatility than gold. And when you think about Tier 1, when you think about the fact that the central banks have been using the Western suppression of the gold market to accumulate gold, when you think about interest rates still rising, the moral of the story is that we now have an environment where treasuries are considered more volatile than gold. And these central banks are shedding U.S. treasuries in favor of gold, which is now Tier 1, just like U.S. treasuries are. And I find it to be very, very interesting. This is a dynamic move where capital is moving away from, fixed income holdings. And I think what you're seeing is a whole new shift And what's that going to do to the 60-40 portfolio model? Does that mean we're going to start to see gold replace the 40% in US Treasuries at some point? I'm not quite sure, but certainly I thought that caught my eye quite a bit when we saw how many countries were shedding their US Treasuries, and the fact that for the first time in 45 years, Treasuries have more downside volatility than gold. That's crazy to me. The biggest money in the world accumulating gold off the hook to the point where it is now more stable as an investment over the last year than almost 2 years than the treasury market. First time in 45 years. That means that the big money like Saudi Arabia, like China, like Japan, they're selling treasuries, which pushes up rates and replacing it with gold. That's exactly what that means.
Citigroup Incorporated has taken a significant step into the world of digital assets by introducing its latest offering, Citi Token Services. This move forms part of the bank's broader strategy to provide digital assets to institutional clients. In an official statement released on Monday, the bank revealed that this new product will enable customers to convert their deposits into digital tokens, which can then be swiftly transferred to any location worldwide. Andy, a prominent voice in the industry, underscores the significance of such moves by major banks. When financial giants like Citibank adopt digital tokens, and when there are reports of a prominent Australian bank going fully digital, it sends a clear message: digital money is gaining acceptance at the highest levels. This acceptance is crucial in fostering public confidence in digital currencies, even though concerns about privacy and other related issues persist.
And I argue it's just getting started. The 10-year Treasury yield at 4.5%, it's the highest since 2007. So rates are really, really rising fast. They continue to rise in a methodical fashion, putting greater and greater and greater and greater strain on the system, in particular the banks, which leads me to the first bank I'd like to talk about today, and that is Citibank. I don't know how many people know this, but Citibank just launched a new digital token service using blockchain to offer digital asset solutions for its institutional clients. And the new service is called Citi Token Services. They're converting clients' deposits into digital tokens that can be used for instant cross-border payments. And it's interesting, if you read the article, they mention well-established regulatory frameworks over and over and over again. Makes you wonder, this fine line between conspiracy and reality. Did they allow the Wild West? Did they know that you would have companies, what was the name of the company? Sam Bankman-Fried, what was his company? Whatever the name of it is. The point of it is, did they allow this to happen? Did they allow a situation where they knew there would be fraud, where they knew there would be unregulated misbehaving, and in order to allow the government to step in and say, well, here is our regulated form of this, and this is much better. And the point I'm getting at is that, you have a major bank that is moving one step closer to a central bank digital currency. This is a situation where this is a private managed blockchain by Citibank, but it is the beginning. I mean, how far removed is it from the bank in Australia, the large bank in Australia, who has now, as of January 1st, has banned all cash transactions? And this is a situation where you're beginning to see more and more and more talk about moving away from cash. And this large bank in Australia just came out and said, yeah, by January 1st, no cash transactions, no check transactions, no phone payment transactions. It will be purely digital. They said you can take up to $2,000 a day out of ATMs, but no more cash withdrawals out of the banks. And by the way, ATMs are disappearing. So we are moving little by little, like the point I keep talking about, logarithmic decay, little by little by little by little, and then all at once, boom, we're in a digital environment. We're not there yet, but you're beginning to see it. And when you see Citibank issue a tokenized form of money for ease in transactions cross-border, it's no different than the Fed coming out with their Fed Now for domestic transactions, which will take the place of checks very quickly. There will be no checks very soon because you will have instant settlement like Venmo, like Zelle, only backed by the Federal Reserve. These are the little pieces of indoctrinating the public into feeling, hey, it's okay. Maybe it is about convenience, and shedding their concerns about the loss of privacy and whatnot. It's the slow acceptance of something rather than throwing it all at you at once. So I thought that was interesting as well.
In light of these remarkable shifts in the financial landscape, what will be the long-term implications of central banks favoring gold over US Treasuries, and how might Citigroup's move into digital assets shape the future of banking and finance? If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.